Inflation. It's been tamed for several decades now, even after massive federal deficit spending responding to the 2008 financial crisis, and even after round upon round of the Federal Reserve's quantitative easing programs in the 12 years since. But after 2020, and now 4 months into 2021, with blowout spending and record-setting deficits just from what's already been passed, not to mention another potentially $3 trillion added to the total through the so-called infrastructure bill being proposed. Well, is it different this time? Has inflation already arrived? If it hasn't, is it just around the corner? Will the Fed be able to contain it? If the Fed cannot, how bad could it get? By how much would interest rates rise? What kind of damage could this do to the bonds in your portfolio? And what sorts of assets might be the safest havens in the face of rising inflation? Also, fulfilling our promise from 2 weeks ago, who was right and who was wrong in our retirement paycheck smackdown debate? We explore all this and more right now on the Retirement Lifestyle Show.
Checks because it was on the wrong mic and I couldn't find the right one.
Okay. Well, it looks like you're for sure on the right one on Riverside.
I am. Riverside has you check it before you enter. So, and now I'm ready to roll.
Okay, so on on Audacity, you're on the right mic as well, Adrian?
Yep. I'm looking at it right now.
So we'll do it on 0, 5, 4, 3, 2, 1, 0. All right, and just make sure you've got a sound wave showing up on Audacity so that everything's connected.
Check.
Now we're back here, and we'll do our clapping on 1 and 0, and then we'll have 10 or more seconds of silence. Here we go. 5, 4, 3, 2, 1, 0.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as usual with Erik Olson and Adrian Nicholson. We are trying to help you live your retirement dreams, and we've got another exciting episode for you today. Erik, you are joining us remote today, correct?
That's so true.
Visiting the
Seattle,
grandkids.
Grandkids, daughter, son-in-law, 10 days, man. I'll tell you what, I haven't seen these little kiddos for 16 months. Yesterday, we set the fun record out hiking out to this one peninsula to a lighthouse in the Puget Sound, and then in the afternoon played t-ball. I lost 17-3. That was with a little bit of, let's say, a strikingly biased handicapping in the favor of the 5 and 3-year-old.
So how was the flight out there?
Oh, that was fantastic. It was full, but it was great. So
yeah, that's awesome. And Erik, you mentioned hiking again. I got to know, when did you start hiking? When did you start getting a passion for it? When did it really become something you love doing?
Sure. Well, my dad was in the Navy, so every 2 or 3 years we'd get sent across to another part of the country for his being stationed somewhere, and let's just put it this way: it's not they weren't exactly putting us in upper middle class neighborhoods with the compensation that the Navy paid. So our strategy across country was to do camping in national parks and state parks. And boy, oh boy, that was what triggered it, because you get to some amazingly beautiful places. And then backpacking starting in high school, and then that just on and on. Do you like to hike as well?
I'm not a big hiker. Well, I mentioned it before. I like jogging, running outside. Yeah. I was thinking about in high school doing cross country, but I was doing basketball at the time. And in high school, I just try to focus on one sport, and then focus on my grades the other way. But it's something I'd be probably interested in the future. So maybe you can take me out for a hiking trip one day. I'd definitely be down for that.
Actually, there's some great hiking right where you are. My brother
Yeah.
took me out there that one time to this. You've got this one national park near you with waterfalls. It's
Great
amazing.
Falls.
Yeah, a lot of Great Falls is popular. I think another one's like Shenandoah. That's like a really popular one. I have a bunch of friends that enjoy doing it, so I definitely have the connections. But yeah, Eric, if you're ever around here, I'd be game.
Fantastic. Let's do it. In fact, there's one guy that was surfing. Actually, there were two guys that were surfing on the water out there in Great Falls National Park. Just they found a little eddy in part of the river, and they were out. And my brother and I were out there. We're going, what? Yeah. So we'll have to bring our boards.
Do you surf?
That'd be awesome. Sounds a little dangerous, but I'm down.
Do you surf, Eric?
Well, I surfed in junior high because I lived in California on the beach, basically.
Interesting. Well, and I'd love to join you guys hiking then as well. Adrian, how are you doing? How's the last week been?
It's been good. It's been solid. I actually figured out a little bit of an issue with my computer right before we started with the podcast. Remember I had said I had issues with my camera sometimes? Mm-hmm. There's a little switch on top that closes and opens the camera. That was the issue.
High tech.
Yeah, I mean, super far away, it's hard to see because it's like a little black switch on top, and it's like a black bar running across, but I finally figured it out. I guess sometimes every time I opened up my laptop, I would just adjust it, and then the camera would be closed. But I finally figured it out. I had such a good feeling of relief coming in the podcast. It really brought my energy up for this episode, but I'm excited to get into it.
You look great. The camera's working.
It is.
That's wonderful. Well, we've got a great episode today for you. We're going to discuss inflation. And it's a very interesting conversation to have right now. It's important to think about for everyone from a real world perspective of just are prices going up and do you need to be prepared for it? And then from an investment perspective, it's important because you've got to think about how do you allocate your assets for inflation, especially if it's going to be very high? You've got a pretty interesting debate in the field where some people are saying we're going to have 70s style inflation and others are saying we aren't. But I'm really looking forward to discussing this today. Adrian, you have something to share about inflation, correct?
Yeah, I'd be happy to. I have a real life example this week. I was looking for some birthday gifts. April's kind of like a big birthday with all like my friends and family. And I went out to this store. I don't want to spoil the gift idea just in case they listen to this. But I went out to this store and there was this particular item I wanted to get as a birthday gift. And I was just kind of like looking at like all the options. I was like, oh, can you show me this like alternative? Can you show me like another one of these? And then the person that was there was like, oh, I wish. Like right now I'd have like 10 different items to show you right now, but our manufacturers, our suppliers are basically all tied up right now with the ongoing pandemic. So we only have like one or two options to show you. That's why the prices are a little bit high. And that's when it first like really dawned on me like, wow, okay, here's like a real life inflation example. Like I don't have anything to compare it to. The prices was raised a little bit compared to what it was online. And it was kind of just like a really not shocking, but kind of just interesting. Wow, you're actually kind of seeing this a little bit when you're going out. And I think it was a great example. What do you guys think?
Yeah.
Oh, that's a great example. Yeah.
It is. I definitely am seeing that and here. You touched on so many things that we're going to discuss today in that story. One is the obvious with inflation of prices going up. But two is the manufacturers not being able to manufacture enough because of the pandemic. And going a step further, the issue in some cases is that the suppliers aren't able to supply what the manufacturer needs enough because of short supply due to pandemic. Actually, I have a similar story where we are looking into getting a fence put in, and our fence person is telling us that his prices are up significantly. What he's got to charge the buyer because of lumber shortage and lumber prices going up. Mm-hmm. So we're starting to see it all over.
You know, I actually saw like a chart on lumber prices, and it's really interesting. Like that's one thing that's just been going up just to look at. But I've heard the lumber price, so I'm not surprised by that story, Roshan. But yeah, that's another great example.
Yeah. So let's get into it. I think where we've got to start with is the debate of Is inflation already an issue or isn't it? And we've got a bunch of data behind that. And then we'll continue on to, well, as an investor, what can you do? What can you do about it? So, Erik, I'm going to pass it on to you because you've got some interesting data to share. And let's start with that. Well, actually, let me ask you before we even share the data: is inflation here already, or do we need to get ready for it, or is it all overblown? What are your thoughts on that?
I think there's evident inflation in energy and in food prices and in housing. And I would also say there's inflation in asset prices. I would say it's that all of those things are true. They're, to a certain extent, though, they're masked by most of the conversation having to do with what's known as core CPI, which excludes energy and food, or the core personal consumption inflator, which also tends to exclude those sorts of things. So as a result, we're seeing headline numbers, or at least core the sorts of things that are in the news about core inflation, as relatively restrained going forward. But I would say there's explanations for some of that, which also I think further are connected to policy questions, and depending on how the policy unfolds, then I would say inflation could be awakened in a big way.
Yeah, and what about the argument, actually, before we move on? Agreed, it's core CPI doesn't include food or energy, right? But the argument has been that those prices swing too much to be which is why they've been excluded. And I remember having this conversation in 2008 when oil prices, there was the headlines then were peak oil, right? And then prices came back down. So then I thought, maybe it makes sense to not have it in there. Do you think it should be in there, and we're missing the boat by not, or is it wise to not have it in there, which would then make core CPI a good measure?
Actually, I'm not that troubled by the exclusion, or at least making the distinction between, here's two versions of CPI, one that does include them, one that does not, and let's look at how they track separately. And as you said, the core is much more stable than the headline version. But my concern is less around either core or energy or food, and it's more around the policy side of it.
Okay.
Which we'll get into.
Let's get into it. Where do you want to start?
Okay, well, I think probably definitions are a good place to start, because then they serve as a foundation for what we discuss next. So, do you guys have a working definition of inflation? I've got a couple.
Go ahead. You start.
Okay. Well, I would just say the conventional one, the simplest one to explain, is too many dollars chasing too few goods and services. Too many dollars chasing too many goods or too few goods and services.
Yeah, I think the supply and demand aspect is really key, and that's like one of the key concepts they taught in my economic class. When there's an increase in supply and there's a decrease in demand, how that affects price, and trying to have that equilibrium where they all balance out is something that is what people are really looking for right now in the economy is extremely important. And going back to the examples that me and Roshan gave, you're starting to see it now with suppliers and how they're pricing their goods and services is really key here, and something that people are going to be monitoring pretty much every day now.
And I'm going back to the definition. I actually want to start with the more simple one, which is prices going up. Right, I think you've described why, right? Both of you described why,
right.
but the outcome is prices are going up. You need more money to buy something today than you did yesterday if you have inflation.
Yeah, okay. So those are some very basic definitions. I think what those definitions and first of all, those align with our common sense, right? So you were using lumber as an example. If everybody suddenly is getting into, hey, well, I'm locked up at home because of COVID shutdowns. I'm going to do some home improvement projects because they haven't forbidden me to go to Home Depot and Lowe's. and Menards and so forth. So off we go, and we start doing all sorts of home improvement projects, or we're building homes or that sort of thing. What happens? The price of building materials goes up, right? And so there's a perfect example. Or if the growers of apples or perishable vegetables or someplace have a big freeze, and suddenly a big part of their crop is wiped out for the year. Now there's a shortage, and so again, supply demand sets it up, and so prices are probably going to go up. If you want one of those apples or those oranges, you'll have to pay a pretty penny to obtain them, right?
Yeah. What's interesting about those examples, though,
ahead.
is like the apples and oranges, and we have this debate now, is it temporary or permanent, right? The inflation,
Sure.
right? So those apples and oranges example, if it's just one season, they might come back down to their regular price, right? And the concern is, are we going to have continued, and our price is going to rise continually, and to what level? And that's where is it a concern or not?
So there's a slightly more, I think, nuanced definition of inflation that's helpful in the conversation about policy.
Okay.
And that is that the definition that we just gave is a relationship where if I said too many dollars chasing too few goods and services, it's really the only two things there is quantity of goods and services and then the amount of money. But really in truth, it's not just the money. It is the velocity of money as well. And so money times its velocity on one side of the equation, and then goods times the price of those goods on the other side of the equation. And what's taking place, if we talk about what's taking place in the expansion of money, particularly since the great credit crisis of 2008, both through deficit spending at the federal level and through the supply of money through the Federal Reserve adding assets to its balance sheet, we've seen a dramatic increase in the amount of money, at least in U.S. dollars, that are in the system. You guys have seen those things as well, correct?
Eric, and I think I saw a chart, and I think if you explain this for our listeners, it might be a little bit helpful. But it was a chart showing M2 money velocity, and the chart basically had it going straight down. Could you maybe go a little bit into that, like defining what M2 money velocity is? And because I looked at the chart and it just showed it's going straight down, and it looks like that was something that you were kind of going into.
Yeah, exactly. So M2, just in the simplest terms, is the supply of paper money in the system minus some subtractions related to certain money market funds and IRAs and such, retirement accounts in particular. And at one point in time, prior to the credit crisis, we had money velocity that was in excess of 2. Meaning in terms of the pace at which it would turn over. More recently, we're down closer to about 1. So if you've seen money velocity essentially cut in half, that acts as a set of brakes, if you will, on the fact that money supply itself has been dramatically expanded. So M2 is way up, but money velocity, the velocity of that M2 is way down.
Well, let me.
You might be saying M2. Why are we talking about M's? Because the Federal Reserve and so forth use a variety of definitions of money in the system.
I want to.
M2 happens.
I just want to explain this a little bit in a little more simpler terms. So, and stop me or feel free to add to it. But velocity is essentially how often money's turned over. If I have $1, I go to Adrian's store and I buy something with that $1. Adrian then goes to Eric's store and buys something with that $1. And if that's the only dollar in the economy, we just had money velocity of 2 because that $1 was used twice. Me and my purchase to Adrian, Adrian from his purchase to Eric. Correct? Okay. Now let's go on to M2. That's essentially... I'm overly simplifying it, but it's money in the bank. Is that correct? So
money in the
so
bank.
what you're essentially saying is the government's printing money, people are getting the money, but they're not spending it.
Close.
Okay.
The government is supplying money,
Yes.
and the Federal Reserve is supplying money. So there are two separate sort of things that are happening
Yep.
here. So on the fiscal side, which is the federal government spending money it doesn't have. Actually, I want to bring up a chart
hold
just to illustrate the point.
And I want to explain this.
I'll finish the definition.
But that's an example of the government stimulus. They spent money, and you're saying
Right,
spend money
so-
they didn't have. They gave it to the individuals.
That's right.
Right.
And the second kind of money is, well, the second way in which money has been injected into the system is for the Federal Reserve to put reserves to raise the reserve requirements of banks. And let me explain what we talk about reserve requirements. Once upon a time, your local bank would take in deposits from you and your neighbors, and then it would lend that money back out to you and your neighbors and the businesses in your area. And it would have to have a certain amount of reserve, recognizing that you know, if suddenly you had an unexpected spike in people coming to the ATM machine or writing checks of some kinds, that they had to have money available, but they didn't need to have every penny of every deposit actually sitting in the vault because it could be lent out. There was a requirement of how much reserve they needed. When the credit crisis in 2008 hit, suddenly there was an understandable concern that banks might fail. And so as a result, the Federal Reserve substantially raised the reserve requirements. But now you might think that alone would create a massive slowdown in lending, right? Because if I've only got certain amounts of deposits from depositors, but now I have to raise my reserve requirement. How am I going to make loans? It's gonna restrict my capacity to make loans, or I'm going to have to offer a lot more interest to draw people in to make a lot more deposits. So what did they do? The Federal Reserve actually supplied supplied money to go onto the books of these banks so that their reserve requirements could be met. But in addition, said if you put deposits with us rather than lending them out, then what we'll do is we'll pay you a fairly high interest rate, probably a higher interest rate on that money than you can actually obtain by lending it out. And so as a result, then what the one mission was accomplished, which was to have an additional form of guarantee that these banks would have a cushion on the one hand. But what it also did, when that happened, it slowed the velocity of money. Because now these banks are saying, wait a second, why would I lend it to the plumber or the person opening the restaurant or whatever when I can make a pretty nice return just by leaving it in the federal deposit framework, Federal Reserve's deposit framework, and earn a nice interest rate. So that's the twin parts of this policy are, just to recap then, are money that's coming in the form of stimulus, but an overwhelming amount of money that, at least prior to this COVID, much more of that money was going into the system through this mechanism through the Federal Reserve. So what's taking place since COVID is now two things are happening. First, the Federal Reserve's expansion of that money into the banking system has increased. But now we're also seeing spending at the federal level that's almost without precedent. Let's just put it that way.
Well, and let's continue on. Let's start with our question of, first, you believe we're seeing inflation already? Yes or no?
No, I don't think we are seeing inflation already, and at least not if we're talking about core. And I don't know that we necessarily will in the immediate future.
So what about and I'm not talking about data now. I'm talking, or at least I'm not talking about data such as core inflation, but we're constantly seeing things go up in price, right? So, for example, and I can give you a whole list of items. Now, granted, the baseline is a little bit of an unfair comparison because this is all from their bottoms last year, right? Last April. But you're seeing, we talked about lumber up 265%, gas 182%. The list goes on and on and on. Why do you feel like we are not? Why do you feel like there isn't inflation yet? And don't let me put words in your mouth if that's not what you were saying. But I feel like I'm seeing inflation. Adrian couldn't buy the gift he wanted to.
Yeah. I'm just worried. I'll be very concerned if I experience gas lines for the first time in my life.
Okay.
That's something that I've heard of that I'm just too scared to ever really experience, where I'm running low on gas. I have to get to Tyson's and I have to wait in an hour line just to get gas, and my car just turns off because I pushed it too far.
And you better be there on the right day in terms of the number on your license plate, right? There was an even and an odd day, if I remember correctly.
Wait, what was that? What are you referring to?
If you're talking about gas lines, I believe you're talking about the 70s and the inflation then. And my understanding was if your license plate ended in an even number, you could go on certain days, and if it was an odd number, you could go on certain days.
Oh wow, yeah, that's incredible. That's definitely something I don't want to experience at all. But yeah, it shows the impact history had with inflation. So that's a big thing. And Roshan, just taking us not off this subject, but example, if you're an individual and you have some cash on hand and there's you're worried about future inflation. What are some things that you consider? Because again, another aspect of inflation are equities. Equities are supposed to, in a way, keep pace with inflation. So how do you kind of weigh like cash versus the equity markets? What's kind of a starting point there?
Well, I think the first thing is you've got to take a position on inflation, right? In general, do you believe inflation is a problem that you should be prepared for or not? And I'm just seeing overwhelming data, and there really is overwhelming data that things are going up price-wise. And the argument I'm seeing is there are people that are saying, is it temporary or is it permanent? And temporary example is like what Erik said. The apples were out of season, apple prices go up, then next season you have apples again, and the prices come down, right? That's temporary. And why I'm going over that with your question on equities is there's a potential for a very interesting dynamic. And I can't say I'm recommending nor a believer in this. At this point, I'm a researcher in it. But you have a bunch of companies that have come out and said they are raising prices. And I just made a short list for us. This is by no means end all, but like Procter and Gamble, who make things like Tide, Gillette razors, all these items for your house, they're saying prices are up, supply is down, so they're going to be raising prices later on this year. Kimberly-Clark, who makes Kleenex, saying the same thing. Whirlpool, Chipotle, that's just to name a few. So we're seeing it all over. Southwest Airlines with gas. Freeport McMoran with copper. We talked about lumber, but home builders. So I'm seeing it all over, right? From technology, paper goods, which tied to lumber. So I think that from my perspective, I think inflation's here, right? And then the question of is it temporary or permanent is the other argument people are having. And I almost come back with, well, does it matter, right? Your question about stocks. I don't see these companies that raise prices lowering them later. So if it's temporary, I believe what's going to happen is we're going to have inflation. The consumer will then start spending more on these items. And if inflation goes away, I don't see the corporations lowering prices after. So that'll lead to greater profits for those corporations.
Yeah. That's a big thing. And a big thing is just the market valuation. That's another aspect. Do you see like a big thing where everyone's talking about the economy reopening, people going out and spending more? There's all this pent up saving in the world right now, and that's something people are really trying to price in. and look forward to. Is that just kind of like a theory that's out there, or that's something that's already being priced in?
No, well, I think you are seeing it priced in to a certain degree. This pent up demand, because you've seen things like airline stocks, going up, and then they've pulled back, and just an example of travel. And Erik mentioned on his flight it was completely full, right? So you are seeing the demand out there, and the consumer is out there, and I think that people want to go out, right? So I think people want to go out, and thus spending money. So I truly do believe there is pent up demand, and then the question is, will that lead to inflation? Right, or as you said, is it priced into stock? So, like, for example, we talked about these companies raising prices. So I don't see these companies lowering, as they said, but I don't think the stocks have included in their price that prices are going up. And let me restate that in a more articulate way. But I don't think it's priced in the stocks that they are raising prices, and that those price raises could lead to profits, right? As they could if inflation is temporary. I've got some other interesting things on this debate that I saw. When these companies were talking about prices going up and inflation in their supply, they are all referencing different things. Like, for example, in technology, we're hearing there's a short supply of semiconductors, right? And if that's the case...
Oh, yeah, I heard about that.
Yeah.
And I also heard that technology, in a way, was helping kind of contain inflation with, like, the technology boom. Like, that's kind of lowering the cost aspect for manufacturers and suppliers to produce goods, in a way, has kind of like held and maintained inflation, so to speak. So I definitely saw that. And then the semiconductor, that's kind of like a new thing in the marketplace, where that is also something people are looking at. You can go a little bit more into that.
Well, the thing is, like, semiconductors will impact everything. The most recent thing I had read was said anything with a touch screen, right? So we're talking about cars, we're talking about phones, tablets, and refrigerators now, smart refrigerators, televisions. So you've got all these things they're impacting, and if you don't have enough of those to sell, the prices will go up. And where does that money end up? Right? That's the whole inflation discussion. Now, Erik started down this path talking about government policy, and this is where it can become really interesting, right? And we talked about the inflation, whether it's temporary or not. The Fed chairman Powell believes inflation's temporary, right? He thinks he's not. He says he's not concerned about inflation right now. He says he thinks it's a temporary thing, that it'll come and go, which is where I was mentioning earlier. Well, will that lead to greater profits for corporations, which would then mean stocks are a good place to be, which, by the way, in the general playbook of where to invest for inflation, stocks are on the list. Now, you've got the other side, Go ahead, Adrian. I'm sorry. Continue.
You mentioned stocks. What about bonds? Because I know that's also like an important part of people's investment portfolios. What do people should consider about bonds if inflation's on the horizon or already here, just for argument's sake?
Well, you know what? I just seen an article about this. So inflation-protected bonds will do better, right, than regular bonds in that kind of environment. And I had just read something about how money has been flowing. Investors have been putting money into these inflation-protected bonds recently.
Yeah.
So if you see, I'm trying to find the exact number, but it said this is actually literally as of our recording today, 1.2 billion went into inflation-protected treasuries or TIPS at the last week, which is the 29th consecutive week of money going into that space, for a total of 14.4 billion has been added to that space this year. So we see that investors are actually adding money to tips right now. So which shows that investors are concerned about it if they're adding this much money to it.
Isn't this sort of kind of like a self-fulfilling prophecy? Like I heard when I was doing my research last night on inflation, like if people are worried about inflation or they're expecting inflation in the future, they're worried that prices are going to go up. So in the present, they're going to be buying more, which lowers supply and just kind of create this like inflation to occur. Have you seen some of that or heard anything like that as well?
Well, I'm going to let Eric, we've missed you for the last couple minutes. For our listeners that can't see, Eric's connection dropped, so he is now back with us. And Eric, I will let Adrian and I have been taking up all the time, so Eric, I'll let you answer that question. Is inflation a self-fulfilling prophecy?
Yeah, that's self. Exactly. Yep.
So is the question, is there a self-fulfilling prophecy to inflation expectations? I don't know. I honestly don't know, because I think in some ways it's you only have, if you're selling, you only have so much pricing power, and if you're a consumer, you're going to still look for, I think, the most competitive pricing with a very depending on the nature of the target of your purchase, ever more information allowing us to fluidly compare prices one to the next. So I'm not sure about that. I think I guess I would come back to some of the larger policy questions. And so since thank goodness for technology, I'm back. But can I show you a couple charts that I think are germane here?
Yeah, please.
Oh yeah, that'd be awesome.
All right. So let me share my screen, and what I'll do here is go to this particular.
Yeah, Eric, we touched briefly on where you were headed, which is government policy. And where I didn't really go in depth with it is I was reading an article that former Treasury Secretary Larry Summers is not necessarily a fan of this $1.9 trillion stimulus.
Right.
And his argument is he's seeing a lot of signs of inflation, and he thinks too much stimulus will force the Fed to raise rates, which will then undercut the recovery.
Yeah, isn't it interesting, because Lawrence Summers has been one of those who said, until recently, famously had said that the amount of deficit spending wasn't really an issue, and that
I don't think he's saying the spending itself, right? He's saying the timing of it, right? Right. It sounds to me like he's not a fan of this, and it has nothing to do with the fact that it's deficit spending. It has to do with the fact that they're doing it now, which will cause the Fed to raise rates.
The timing of the stimulus. Yes, that's right. So, but I think people had understood him to be part of this camp that's known as modern monetary theory, which essentially says, why should we ever worry about massive deficit spending? It's not really an issue to add increasing amounts of debt, but you're right to point out that that's a distinct statement from is stimulus of unlimited amounts at all times an unmitigated good? And I think the answer is, in his case at least, his argument is that no, it is not. So anyway, what I've done here is to develop or provide a graph that just shows, going back to 2000, how much, at least at the federal level, we've seen in the way of federal deficits. And you're seeing 2020 on the right-hand side with a $3 trillion deficit. Now in 2021, we have passed a $1.9 trillion stimulus. That's above and beyond the already large federal expenditures that are built in and baked in the cake. And now we're talking about still another $3 trillion spend as well on additional infrastructure. So you start thinking, okay, how much of a good thing is there? So what I want to show at this point is then a different set of tabs here. This one, I just want to show on the left-hand side the composition of the 2021 federal budget. And so you see this is on the left-hand side of this particular graph. By the way, this is a credit goes here to J.P. Morgan, which issues a quarterly update to its widely popular guide to the markets. We'll have that in the show notes. A copy of will be available there. But this is from page 27 of that guide, published March 31st. And so, of course, some of what spending may be isn't yet known because not all of it has been passed yet. But as you look on the left-hand side, building from the bottom, you see the major building blocks of spending in our budget at the federal level: Medicare and Medicaid, Social Security, defense, non-defense discretionary. Then currently net interest is only $300 billion. I should say only. I can't believe I'm saying only, but that's $300 billion in relationship to 28 trillion of indebtedness or debt. And then other spending of various kinds now is part of what's being advanced in this American Rescue Plan. Look on the right-hand side, though, of that same pair of graphs on the left. This is the income that is going to pay for those things on the left. So you have essentially income taxes on the bottom supplying $1.6 trillion, corporate taxes, Social Security and Medicare payroll taxes, and then some other. But essentially, half of what we would spend in 2021, and this is without adding on another $3 trillion spend, half of what we would spend in this year would be financed through additional borrowing. So I think when people see this, and they see the graph that I had shown just a moment ago about the massive growth, they're rightly asking, well, wait. Okay, we've managed to contain inflation even in the wake of the massive infusion of additional capital that came following the great credit crisis of 2008. Is it conceivable that we're going to be able to continue that without inflation? And I think that is a major worry for people, as well as you look at that not just in raw dollar terms, but you look at that in relationship to GDP. So here on the left, what you're seeing is the amount of borrowing relative to nominal gross domestic product for the United States. And at the government level, it's just now skyrocketed from, in the Great Credit Crisis, it was about 60 and it rose to 100. Now, after floating in that 100% area for a while, it's skyrocketed again from 100 to nearly 130% of GDP. How much longer can that go on? I think is a reasonable question. Do you want to comment about that at all?
Well, it's the numbers are ridiculous. Actually, if you go back on that slide, what really stood out to me on the previous one that had the deficit, the borrowing, like you had said, it's about half of the money's got to come from borrowing. But then if you look at that federal budget deficit surplus chart on the upper right, just look at how huge that is and what's expected to continue, right? Like their projection is by 2031 we're at a almost a 6% deficit, which actually looks very reasonable compared to 16%. You know what I mean?
Yes,
looking
I
at
do.
At that chart, it's which is to a certain degree, that's just a ridiculous statement to make. I know the government's not a household; you can't necessarily compare it. But I always find it hard to do to say to someone, well, you're spending 15%, 16% more than you make right now, and and you're going to drop that down to 6. Hey, good job. You're on the right path. And that doesn't feel like a statement you can say to an individual. And individuals, I understand you can't print money as the government can, and so on. But it just it's definitely concerning, to say the least, for the future. But getting us back to the inflation argument, I remember back, this was a very hot topic as government was spending to get us out of the the Great Recession, the 08, 09, and so on recession, was, will there be inflation? At the time, Bernanke was the Fed chairman. He's known for his nickname of Helicopter Ben, because he had said that he would drop money from the sky if there was an issue with deflation. So that's where he got.
Wasn't that like his thesis when he was in school or something? Like that was like the title. I'm just gonna go in a helicopter and drop money down to people.
I don't know if that. I don't know that could have been his thesis. Where I first heard about it was he gave a speech, and I did look it up again in preparation for this podcast. And in that speech, he credited Milton Friedman with the statement. So it may have been in his thesis as well.
I mean, it's interesting. I mean, I was watching a movie last night, and there was like this pretty powerful quote in it, and it said, "When the bill comes due." And Roshan, you mentioned earlier when Erik was showing you those charts of all this spending, all this borrowing, and you said it's very concerning for the future. And my whole life is ahead of me. So what's kind of going to be worst case scenario, and what would be kind of the best case scenario with all of this? If you kind of put your cynical hat on and your happy hat on at the same time.
Wow,
I want to take a stab at that, Adrian. The happy scenario is that it's possible to indefinitely maintain extremely low interest rates, and a happier still scenario would be if the federal government and we as a people could agree that we're going to not only stop deficit spending, but we're going to whittle that debt down. That's the happiness. That's the happy scenario.
And be easy with the cynical side, Erik, because I know how you can be sometimes. Let me down easy if you have to.
The cynical side is that at some point it gets to the point where people just are starting to turn to say, okay, how do we deal with the debt? Because already foreign purchasers of U.S. debt have said, enough is enough, and actually gradually they are deleveraging, I guess you could say, and selling back some of the treasuries that they had purchased. So now, if we get to
Erik,
a point,
your cynical scenario is much less than my extreme comparison scenario that I like to do. But I mean, if you really play this out to the extreme worst case scenario, it's a currency default.
Oh, I agree with that. Yes.
Right? Interest rates go up. The government can't finance their debt. They can't keep borrowing because there's no one that's willing to lend them money. And once again, the borrowing is to finance the debt. And then you've got to devalue the currency and have some kind of default. Which
is this something similar? What happened? I believe it was like a year ago, a year and a half, where like China came out and said they were devaluing the currency, and like the markets were just like going down. Is that something similar what you're talking about, like the U.S. would do, or is this something different?
Definitely different, because what China did was they are taking their currency and they are essentially pegging it, right? So they just said, all right, we're changing what it's worth. A currency default is when the government says we can't afford to pay our debts, and they just default, right? So they stop paying their bills. So that's where it would just be that would be a huge shock. Now, I don't expect this, by the way, but you had asked me for an extreme positive and an extreme negative, and I was comfortable with Erik's extreme positive of you keep spending, maybe GDP goes up, and you can slowly pay this thing down, and interest rates stay low. I would agree with that, but his extreme negative was a little bit more of a rosy picture than my extreme negative.
Well, I haven't gotten to the extreme negative yet, but I will just say, I would say an intermediate negative would be that we're not really able indefinitely to the markets take over. So far, the Fed has sort of dictated interest rates, But if the markets really took over and said we doubt we question the whole system here, and rates start to rise in such a way that the federal government is essentially forced to finance at higher that $28 trillion and growing at much higher interest rates. Think about it just for a moment at 4% interest rates on $28 trillion. So now you're talking about over $1 trillion a year. Over $1 trillion a year of that budget is going to debt service. And if they're not raising taxes to cover that, then that's just being added to the additional amount that has to be financed the following year. So I think that how do you, one way to solve that is to inflate your way out of it, so that you grow maybe not real gross domestic product, but at least nominal. That is to say, building in the inflation, so that you have a lot more now less valuable dollars to pay back the debt that you had amassed.
Ed, hold on, Eric. I want to take you back for 1 second. Mm-hmm. You had just mentioned $4 trillion in debt service.
Mm-hmm. $1 trillion if it's at 4%. If it's at 6%, you're at over $1.5 trillion of debt service. Just interest payments.
Yeah, and currently from that J.P. Morgan thing, interest payments were $303 billion.
Mm-hmm, mm-hmm.
So when you're talking about a 10x on those interest payments, which I just don't see how things could sustain. Right?
Well, I'm talking about a 3 or 4x if it goes to 4%, and I'm talking about essentially a 5x if it goes to 6%, and that assumes that we are also able to hold the line at $28 trillion of indebtedness, which, as you just saw, with $3 trillion being financed just for 2021 alone, without the addition of an additional $3 trillion so-called infrastructure bill. I mean, it's like, what?
It's crazy. Well, let me move us on to the other side of this, which is how should investors react?
Mm-hmm.
So if you're an investor right now,
mm-hmm.
and let's say you're concerned about inflation, and I don't want to have the debate of is it permanent or temporary.
Yeah,
let's say it's permanent. What do you do as an investor to
mm-hmm.
prepare for yourself for it?
Well, I think there's a few things. By the way, I'm just going to show I want to show something on my screen here that's related, once again to this question of the balance sheet issue. So let me just show this, which is now we're talking about the Federal Reserve at this point, as opposed to merely what we're talking about in fiscal spending. This is what's been happening on the Federal Reserve side. Until 2008, you saw the assets on the Federal Reserve balance sheet were less than $1 trillion. And now just treasuries and mortgage-backed securities, just those two were at about $8 trillion. So a huge leap has occurred here in 2020. And by the way, I think this is important to note, it started before COVID was announced. This started in October of 2019, and I don't really understand why. That's like, what is it that the Federal Reserve needed to start accomplishing in 5 months in advance, or 4 months at least in advance of this perception of this global pandemic? That's puzzling to me. But how, coming back to your larger question, how should people respond? Well, one thing I would say is that I think you need to think about what's taking place on the bond side of your portfolio. So if we have inflation, and if that results in an increase in interest rates, on the right-hand side of the screen, you can see what happens as an impact of a 1% rise in interest rates on various types of investable instruments that you might have out there. So in looking at even long-dated treasuries, 30-year treasuries, on just the price portion, the price return of a 1% would drop by about almost 20% in their value. and on a 10-year, it would drop by 9%. So you need to be thinking about what's going on the bond side of your portfolio. We conventionally say a conservative portfolio might be, and depending on your definition, 80% of your portfolio is in fixed income. Wow. If we have an interest rate rise that's coupled, stimulated by an inflation rise, then 80% of your portfolio is in a category that is subject to some exposure of decline. So, guys, any comments about that? That's one thing I think you need to ask yourself is, what do I not want to invest in?
Well, and I do have a comment on that, which is this has already started, right? Like the ETF that tracks the 20-year Treasury, that's down about 11% so far this year. So that's my first comment is it's already started. The other thing that stands out to me on this chart in particular is that, with the name like inflation protected securities, the TIPS, the Treasury inflation protected securities, you would think you're safe, but you'll notice from this chart you're not. Right?
Well, this is a statement about interest rate rises, not the inflation part. So there is actually an inflation protection in it, but not an interest rate protection necessarily.
And the other one that stood out to me on here, just because I think naturally, and Eric, great point. I was thinking inflation, whereas that's an interest rate comparison, but floating rate you would naturally think would be a safe place.
Yes.
Right, with something like this. But if you look at it at the bottom, I mean, it's better than the others, but it's not great either. You're still losing. So bonds are an interesting one because I do value the potential hedging it gives you versus equities. However, if you're going into something that is likely to just continue to decline or maintain a position in there, it's a tough argument to make. Like which risk is greater? The risk that equities go down and your bonds appreciate because money's flow into it, or the risk that, yes, that might happen, but before that happens, you're going to lose a bunch of money on your bonds because of inflation or interest rates.
And Roshan, just for conversation's sake, just since we touched on equities and bonds, what's kind of your opinion about cryptocurrency? I know that's like a hot topic. That's what people are looking at as well. What's kind of the relationship you've seen it have with inflation or kind of its role in it? And I know like a big thing people were talking about was that famous meme cryptocurrency, doggy coin. I like calling it Dogecoin after the little dog. What's kind of your stance on it right now? Or your hot take?
What's weird is I don't know if I'm allowed to have one because we're not allowed to do much with crypto. And for our listeners, we had a previous episode with crypto we weren't allowed to share with you for compliance, which is where my hesitation comes into play. But I'll tell you this, Adrian. What I find very interesting with the whole crypto debate and argument is there are a lot of believers in crypto that say it's a better quote unquote store of value or inflation hedge than gold, right? And so that a typical category people go into when they're concerned about inflation is gold, and gold has gone up, but in the last year, but not to the same degree as all these other commodities. Like I mentioned at the beginning of the show, lumber was up 265%. Gas prices were up 182%, while gold was up 3% in that same time frame. Right? So gold hasn't gone up as much, and I don't have the exact data on what crypto has gone up, but I believe at the beginning of 2020, you had Bitcoin in the $20,000 neighborhood, roughly. I'd have to look that one up, but right now it's at about 50,000. Right, so could that be some validation to those who say it's a store of value because it went from 20,000 to 50,000 in the year that the Fed printed 40% of all the dollars they ever printed, right? So there you've got an argument, and a big thing with Bitcoin, as we're talking about the crypto space, is that you have limited supply, right? So you've got the government printing more than it's ever printed. You've got this other alternative crypto, I want to say alternative asset, but I don't know if we're allowed to call it an asset yet or not. But so this other alternative in crypto that just went straight up on the same year that you've got printing of currency going straight up. It may be coincidental. We may not have enough data points. It's just a very interesting comparison. So, Adrian, I think I answered your question, or I answered around around your question. I definitely find it an interesting place, and it's nice to observe what's going on, especially in comparison to gold, because that's one of the arguments for crypto. Mm-hmm. Eric, any thoughts?
Yeah, I would say I do have a few. So, I mean, just think about what sorts of things provide a hedge against inflation. They include, as you've already talked about, historically at least, precious metals. Here's one, a figure, or a statistic, or at least a factoid that I was not aware of, but I believe it's something that along the lines that an ounce of gold would cover as the cost of a centurion in ancient Rome, would provide as much income for that centurion in ancient Rome as an ounce of gold today would provide for a captain in the U.S. Army. Isn't that interesting? That over 2,000 years, an ounce of gold as a measure of a comparable amount of comparable to the income of those two soldiers, or at least officers in their military, was about comparable. So in terms of as a store of actual purchasing power, gold has served that function. Now, I would say gold it has served that function because people believe it serves that function. I don't know that there's necessarily something intrinsically there's not intrinsic worth in gold. It's just something that, because of its limited supply and so forth, that it has that attribute about it. And it can certainly rise and it can certainly fall, but it does have. So precious metals might be one area. The problem with precious metals is that they're not quite as liquid as some other things. And so when you talk about crypto, this is not a statement that we're advocating crypto for everyone, but it's certainly, as the crypto, or the crypto asset, not just cryptocurrencies, but crypto assets as a whole, as that market matures, it may become, as you had pointed out, a substitute for other finite commodities that have served as stores of value over time. So another thing I would say is real estate and other real assets. So if you think about the real estate, it's you're talking about a tangible asset. And I'm thinking about the period of hyperinflation in Germany in the interwar period. People were taking Deutschmarks, and you'd have wheelbarrows full of them. So the currency itself didn't hold the value. I'm not saying, by the way, this is not a forecast of hyperinflation in the United States. It's just talking about using this one isolated example. But if you held commercial real estate, then in terms of preserving value, that was, or for that matter, housing, that was a substantial store of value there. And the list goes on. You talked about tips. So Treasury inflation protected securities, I think, are a good example of something that works this way. I would say, are they better or are they worse than the regular Treasury? You will only know when they reach maturity, because if inflation winds up being higher than was expected at the point of purchase, then the adjustment built into the tip will reward you more because of that inflation. Whereas if inflation winds up being dampened relative to your expectation, then it will work against you, because there won't be as much of an adjustment to offset the fact that you accepted a lower interest payment throughout the life of that. So real assets, precious metals, we talked about, in this case, tips. And I think
we mentioned it earlier, but commodities are another one.
Commodities, although the problem with commodities is that you can, if you deal with them in the real commodities, who's got an oil barrel or a corn crib in their backyard so you're paying for storage and delivery, and you often have to mediate all of that or solve that problem through the futures market, and then you have time decay, and you have on those futures contracts. So this process of contango can work against you. And
Yes.
then finally, I would say stocks, equities.
Yeah.
If we have seen one area of massive and undeniable inflation over the last 12 years since the credit crisis, it has been in risk assets, as people have fled to those because of low interest rates, meaning they can't find yield in fixed income.
So for those of you listening to this with inflation on your mind, I think the first step is to come to a conclusion as to whether you believe it's temporary or permanent. And then once you've come to that conclusion, we've given you a list of areas that you can start looking into for opportunities. And that temporary or permanent thing really makes a big difference. Erik, you mentioned the real estate, and that's an area where there's a hot debate right now as to, are these increased prices temporary or permanent, right? So if you believe inflation and these prices are temporary, you wouldn't want your money there, whereas if you think they're permanent, you'd want to get them there as soon as possible. So that's just an example of we, as we always do, we are giving you additional homework if you want to actually execute on it. You've got to think these things through a little further. Gentlemen, we covered a lot today, from data, historical inflation, future inflation, the cost of a centurion, and do you have anything to add in closing?
Well, I will just add this, and each of you may have something more to add, but I want to highlight the point that I made very early in this, is I don't have an expectation in the short term of elevated inflation. I do believe that we're in for a still, in historic terms, a very subdued period of inflation overall. And certainly you'll find some exceptions to that, and you've pointed out several of them. But I would say I wouldn't be surprised if 5 years from now, if we look back, that we'll have seen inflation in the high ones to the mid to high twos on an annualized basis, not above 3. I would be surprised if we're above 3% inflation on a compounded basis between now and 5 years from when we are recording this.
Yeah, it will be interesting to see as far as which way it goes, and I tend to lean towards what you said, just because higher inflation leads to higher interest rates, and I just don't think the government can afford it. So I think they'll do everything they can to keep a good handle on that, and that's one of the Fed mandates. So,
and there's one other thing. One other thing that I do want to add, and again, this isn't to preclude either of you from adding further and final comments, but I would say we touched upon hyperinflation, and we touched upon this sort of thing. I also want to emphasize that we're not. At least I'm not forecasting hyperinflation. I do think that those currencies that enjoy that are like the dollar, like the euro, like the yen, that have, especially the dollar, a preeminent place in international commerce and serve as sort of the international currency of choice or currencies of choice, they enjoy a different sort of capacity for, I would say, fiscal malfeasance, or at least misfeasance, than does, let's say, a smaller country whose currency doesn't function that way. This is not Zimbabwe. This is not Greece. We're talking about the United States. And so from that standpoint, I just want to emphasize here, I'm not at least forecasting hyperinflation. Certainly not hyperinflation.
Yeah. Agree. Adrian, any things in closing?
I'm all set. I really enjoyed our discussion today. I pretty much think we did a full 360 on inflation. I really enjoyed some of the kind of topics and ideas we brought up.
So, Adrian, without asking you what it was, did you buy that gift or did you not because the price inflated too much?
It took me a while, but I ended up buying it.
Okay. All right.
I was seeing if I could get a discount. I wanted to kind of like bargain, kind of haggle, see if I could do that. But they don't do that at stores. But I tried.
And by the way, I do want to add 1 minute, as we had promised 2 weeks ago, that we would come back and resolve the big debate that we had about the retirement paycheck smackdown. So we could save that actually till next week if you'd like. We've gone on for
I'd
a
like
while
the
here.
conclusion because I believe I'm vindicated in that conclusion. But we'll share the details in a future episode. But Erik, I was right? That's the bottom line.
Well, I would say neither of the two tools that I used showed that a 22% conversion would be useful for the client. So, which in that sense, yes, you were absolutely right. And in fact, one of them went so far as to say you were fundamentally wrong. And that is you and I both, in that neither of us had anticipated the possibility that she should, instead of doing Roth conversions up to the 10 or 12%, the top of her 10 or 12% bracket, ought to do not only no conversions, but ought to burn through her Roth for the first 3 years, postpone Social Security, and then from that point forward, live off the balance of her assets, which I was really surprised by.
Yeah, that's why we do the analysis, and we always encourage everyone to do their homework on each thing, because I've never seen that before, and I would not have, conventional wisdom would not have led me down that path either. So it's interesting, and we will definitely break that down further on a future episode where we talk about how to manage your investments from a tax perspective, using your taxable, tax-deferred, and tax-free accounts to manage your investments. This has been another episode of the Retirement Lifestyle Show. Thank you for joining us. We hope you found it valuable and helpful and can actually use some of this in your life. And we'll be back to you next week with another interesting episode.